I'm joined today by Denis Cole, Principal and Head of Portfolio Specialist Group at PGIM. Dennis is among the incredible investors sharing insights at the Fixed Income and Alternative Credit Investment Forum today. Welcome, Dennis. It's great to have you with us.
Thank you very much. It's great to be here.
Let's dive straight in. When should an investor choose a broad, multi-sector credit mandate versus allocating on a single sector basis?
All right. So that answer will depend on a lot of variables. But if we're going to boil it down to a few, it's about how well you can asset allocate, how quickly you can change allocations, how well you can manage the correlations of all of these sectors. So generally speaking, the more flexibility a manager has across their mandate, the better the total return can be. So unless you think you can asset allocate amongst sectors better than the manager you'd select, it's likely better to have a multi-sector mandate. There are a number of benefits to a multi-sector credit mandate. I'll start with, a portfolio with multiple flavors of fixed income is simply going to be more dynamic. It allows for more diversification across sectors, geographies, credit quality. The manager, you select allocates across those for you. They're very close to the market and likely have an edge in allocating across sectors where they're an expert. Allocation changes in a multi-sector credit mandate are also likely to be much faster and much more opportunistic than having a handful of single sector mandates. You'd have to move money very quickly from one manager to another in order to replicate that. And it's almost not possible to do that in the reallocation process. You have to redeem and subscribe to other mandates. Having one manager do that for you is much more efficient in terms of changing the allocations. Then when we look at it from a risk and a correlation perspective, all of these assets have differing degrees of correlations to one another. One manager who's managing an entire portfolio can manage those correlations. A group of managers working separately cannot. At the end of the day, all that sounds great, but the proof's in the pudding, right? Performance is what matters to us. By allocating dynamically across sectors, a multi-sector credit portfolio can do two of the most important things a manager can do in our business. One, provide you with a higher return and reduce downside by avoiding problem sectors within credit, but also improve your Sharpe ratio.
Are there structural opportunities in a multi-sector credit mandate, or is the benefit in rotating sectors based on relative value?
So it's both. I'll address structural opportunities first. So, from the structural side, securitized products are a great way to generate stable outperformance without taking incremental risk or giving up much liquidity. So, let's talk adding high quality, but still very liquid CLOs, ABS, RMBS, and CMBS. It's incredibly important. Generally, they diversify risk. They go beyond just corporate or sovereign risk. It can access spreads from the consumer, commercial credit, housing, financing, and so forth. They also have higher spreads per unit of duration because one, there's a complexity premium, right? You need a very sophisticated team to be looking at these deals, as well as there's a sizing premium. Oftentimes, you can only buy these deals in large sizes. At the end of the day, the biggest reason that they trade so cheap, and there's this huge advantage, they're not in a benchmark. So you don't get benchmark huggers or passive managers buying that. That doesn't exist. When you do the analysis on adding securitized products to a portfolio, the end result is one, pick up an excess returns. Obviously, that's incredibly important. It provides diversification. And then frankly, all of that moves the portfolio and the efficient frontier of that portfolio, upwards, higher return, and to the left, less volatility. The second part of the question, sector rotation, right? It's obviously incredibly important, but it's not as easy as it sounds. It requires a well thought out approach, combining top-down analysis, as well as really deep bottom-up fundamental research, and then really complex risk management that can identify and manage all those types of risks that are introduced into a portfolio from different types of assets.
What are the skills an asset owner should look for in a manager when assessing its aptitude for a multi-sector credit mandate?
So we're talking about creating one portfolio from a lot of different sectors, which tells you right away you need a team with a lot of resources. So I'd say, first you want to find a manager that has really strong expertise managing standalone mandates and all the asset classes that you're going to have exposure to. You want to find managers that have shown their ability to generate alpha in those sectors on a standalone basis. Next, you want a manager that has both a team and a proven framework on how to allocate across all these asset classes dynamically. The third is scale. So to capitalize on some of the structural opportunities that I addressed in the previous question, some asset classes like securitized credit or private debt, you need scale to be competitive. Often in those asset classes, if you cannot source a deal or if you cannot take down an entire deal by yourself, you simply lose access to that deal. So you need a manager that has meaningful AUM that can access those deals for you, even if your portfolio isn't that large. And then I'd say the last one is risk management, right? Which I touched upon in the earlier question as well. But you have to do your diligence and find a manager that has a really thoughtful risk management framework that it can account for all the risks in a portfolio of varying assets. So you want to look for a framework that can identify both systematic as well as tail risks, and then a manager that can stress test your portfolio as well. I mean, at the end of the day, you can only manage risks that you can identify. So make sure that the manager you select has a robust process.
What is a good benchmark for a multi-sector credit mandate or portfolio?
Okay, so I don't want to dodge this question, but the answer varies based on the client's needs. We use a multitude of benchmarks, a variety of the Bloomberg aggregate indices, the US Ag, Intermediate Ag, the Global Ag. We use the Bloomberg Multiverse. We use blended benchmarks as well, different credit mandates. But I'd say, the big advice there is be flexible. A good manager can take a total return approach, manage against cash if that's the client's desire. My biggest piece of advice to a client that we speak to is, present us with the issue or your goal. We can always find a solution to address that goal.
Are there particular subsectors of credit that stand out in terms of great relative value?
Mm-hmm. So right now, there are really, a number of really good themes, but they all run. So I'd say, investment grade corporate debt is really tight. Fundamentals are not as strong as they were a decade ago. And because of that, they're unlikely to produce strong risk-adjusted returns given where spreads are. So for us, it's a very easy underweight. Where there's a lot of value is in high-quality securitized credit. I said earlier, so AAA CLOs, non-agency resi, front-page CMBS. We also really like short-duration high yield. That allows us to earn really good carry, but still maintain liquidity to capitalize on convexity and deploy capital if spreads widen. I'd say within, high yield, we're really research driven. We're looking for idiosyncratic opportunities because spreads are pretty tight. So if we use an example, we really like home builders in the U.S. So the U.S. is undersupplied by 2 to 4 million homes right now. It's going to take years to reach equilibrium. There's also more competition for new builds as current homeowners can't sell. So many homeowners have a mortgage well below 4%. They can't sell their homes just to take out a new mortgage at much higher rates. That favors new builds. And then last but not least, I'd go to EM debt. It looks very attractive. Like high yield, there's really good carry, but also like high yield, you got to do your credit work. Overall, within EM, I'd say growth differentials tend to provide performance. Right now, EM's the bright spot as developed market growth is pretty low. And then fundamentals, right? So EM sovereign fundamentals are improving, developed sovereign fundamentals are deteriorating. The dollar has been much weaker. It's our view that the dollar is likely to continue to weaken as well. That's a powerful tailwind to EMs. It lowers their overall debt. It lowers inflation. It's additive to growth. EM sovereigns also, provide really good diversification, as well as, that important spread pickup to develop market fixed income. And then what I kind of say to drive that point home is, the points earlier from home, is the opportunity set can change really quickly, right? Given where valuations are, given elevated risks and uncertainty coming from policy, geopolitics, as well as uncertain growth environment, that's where, multi-sector credit mandate can excel, right? Being able to shift those allocations to meet the next market environment as the current environment changes.
Denis, thank you. We're going to have to leave it there and get back to the forum. I really appreciate you sharing your expertise with us today and for being a part of Global Investment Institute's Fixed Income and Alternative Credit Investment Forum.
My pleasure. Thank you very much for having me.